something like this can be really problematic if the business cycle peaked and we're on the way down. That's what tends to exacerbate slowdowns. If the business cycle is rising, driven by liquidity and financial conditions, which is what it has been, and I'll show you some stuff on this in a sec, then these tend to be short, sharp corrections, a pause that refreshes, a kind of resetting of leverage in the system that allows the markets to recover, and often very sharply because it's followed by liquidity. You see, when the cycle's falling, it usually means inflation's too high, and therefore they can't inject liquidity and don't want to. But this is the reverse, right? So this is actually a magic setup.
Friday saw global stock markets move due to U.S. economic concerns. The Japanese Nikkei dropped 12% on Monday, its worst day since 1987's Black Monday meltdown. Seconds after New York's opening bell, South Korea's Kospi Index plunged 9% and the Nasdaq fell 6%. Bitcoin and Ethereum had their biggest single-day drops since the FTX crash in 2022 and 2021, respectively, and the VX. A stock market volatility measure has soared 90% in days and is nearing multi-year highs, but the market rallied marginally on Tuesday. Many question if Monday's remarkable gyration caused uncertainty, marked the conclusion of last week's worldwide sell-off, or the start of a global crash that might transform the globe forever for popular macro analyst and former Goldman Sachs executive Raoul Pal. Business as usual, it believes the sell-off might be a tremendous positive for the crypto market because it will push central banks to lower the dollar and yen to relax policy without jeopardizing R and B. Yellen has been to China twice to discuss this. US rates must drop to help. Revaluing the Japanese yen was part of a central bank deal to stimulate the economy with cash. Growing global economy, everybody wants a weaker dollar to increase liquidity, alleviate financial conditions, and fix this regime change mess. Cane dollar is no longer distracting. Pal highlights how this catastrophe matches his projections for the US and worldwide economies and cryptocurrency prices in a recent video. For more Pal videos like this one, subscribe to the channel and switch on post notifications. Your efforts boost the YouTube algorithm and channel growth.
So we start to see yen intervention. Now, the thing about the yen, as the Japanese also raise rates, the thing about the yen is that a lot of people borrow in the currency because it's cheap, and then they invest in other assets. It's called the funding trade. And that's all well and good, and it can deal with normal volatility. But once the Japanese started to intervene in the currency, it starts knocking people out of their positions. Those positions become less profitable. So what happens is they are forced to reduce risk. In banks, it's called VAR and hedge fund, which is value at risk. So if the currency moves a lot, their funding currency, or in fact, any major currencies, what they have a tendency to do is start having to liquidate other positions. That started knocking into the Nasdaq, riskier assets, as people start reducing the higher volatility positions, and it knocks all the way through the chain of all assets. That's why you get this correlation of one event when everything moves together when they weren't correlated before. It's because everybody's forced to puke risk at the same time. So the risk puking had started and then really started to gather steam. Now, for all of us, this is like, what the fuck are you doing? You're nuking my bags. I get it. But again, there's a bigger game to be played. The bigger game is they want liquidity into the system. And to do it, you're going to have a regime change, and that creates a macro spasm. Now, these macro spasms are not uncommon. You tend to get one every business cycle, particularly around regime changes. So, we saw one in 2018. That was at the end of the hiking regime. We saw then this spasm as the market essentially forced the Fed to pivot, the Powell pivot moment. But actually, the most similar was 2016. Early 2016, the dollar had been so strong, it had pressurized global commodity markets. The Chinese were under huge pressure with their economy, as were the Europeans, and we needed to do something. Yet again, the Japanese started the ball rolling by starting to intervene in the currency markets. That pushed down the dollar, and a big unwind happened. Markets puked for a short period of time as this happened. But the Fed then stopped hiking. They was just starting the hiking cycle. And if you remember, they then stopped for an entire year. But others managed to massively inject liquidity because of the weaker dollar. And what did that do? Well, it set off markets after this spasm into a huge bull run. 2018, a huge bull run, because what you're allowing is the injection of liquidity, more cowbell. So that's where I think we are today. We're setting ourselves up for liquidity, but we need to digest the volatility of the currency move first. Now, how long will that take? Usually, it takes a week, 2 weeks, 3 weeks, sometimes 4 weeks. We've got the added complication of what's going to happen in the Middle East. I don't know the answer to that. But anyway, these are the kind of factors we're playing with. And I think of them as spasms. These are short-term macro things that don't affect the view. You see, something like this can be really problematic if if the business cycle peaked and we're on the way down. That's what tends to exacerbate slowdowns. If the business cycle is rising, driven by liquidity and financial conditions, which is what it has been, and I'll show you some stuff on this in a sec, then these tend to be short, sharp corrections, a pause that refreshes, a kind of resetting of leverage in the system that allows the markets to recover, and often very sharply because it's followed by liquidity. You see, when the cycle's falling, it usually means inflation's too high, and therefore they can't inject liquidity and don't want to. But this is the reverse, right? So this is actually a magic setup.
According to Pal, these macro spasms happen quite often during times like they only last a few weeks at most, but they pack a lot of punch, and they always end with central banks flooding the markets with more cash. For Pal, this couldn't have happened at a better time for central banks because it easily solves the problem of refinancing the world's huge debts at high rates. Now there is a reason for central banks, like the Federal Reserve, to cut rates as sharply as they can without causing widespread panic. One of Pal's posts on X gives a good, easy summary of what's going on. That will solve the problem of the world's central banks having to pay high rates to refinance their debts. Over time, I think rates will go down to 2.5% next. However, they will need a lot of cash to pay off the interest payments from the last cycle and roll them over, which will happen in due course. We might even have more cowbells. War is another reason to inject liquidity, but it brings with it even more unpredictability, FUD, and volatility. Instead of freaking out about price changes, recessions, and the world economy as a whole, people should focus on. A friend of mine says that people should think about whether anything has changed in the business cycle. He says that we are still at the bottom of the business cycle, with a lot of financial conditions getting easier thanks to the falling dollar and interest rates, and a lot of signs that a good recovery is coming. The founder and CEO of Real Vision talks about some of these signs in his video.
So let's talk about the banana zone, because everybody cares about banana zone. All of our hopes and dreams are in it. And I don't want the stupid fucking, well, you promised bananas. I've never promised bananas immediately. I've told you this is how it plays out. This is a period of time. I've also talked about the boring zone. So you've seen this chart before, but now we've just added the percentage corrections in the boring zone to make it even more clear to you guys how this works. So boring zone 2012, 27%. Boring zone 2016, 38%. Boring zone 2020, 20%. Boring zone 2024, 27%. Right. So it's smack in exactly what you'd expect. And what comes next is the banana zone. And I don't want you guys to miss it because you're getting caught up in short-term time horizons of traders on Twitter. That's their time horizon. Nothing wrong with being a trader. I just don't think you'll make as much money. So I think you're better off to think of the long-term gain is how do I use these kind of opportunities to put as much money in as possible so I can capture the big upside when it comes. And I've shown you why that's not just a hunch based on these charts. It's actually based on the everything cycle. And that this macro spasm is actually the opportunity to really think about this, how you want to get involved, where you can find money to add, how you can get your portfolio set. It applies to tech stocks. It applies to equities overall. It applies to emerging markets. All of these things are setting up perfectly, even to commodity manufacturers, mining companies, any of these things, car companies, all of the cyclical plays, they're all driven by this. So this is the opportunity that you've been asking for. This is the last chance to be able to do all of this. So I look at these with glee and say, thank you. All I need to do is find some money to put in because I'm max allocated, but I do have an income. So I try and scrape my bank account for any excess that I've got that I won't need over the next few months and stick them into markets. I mean, I don't sell anything in crypto. I've not sold anything.
In the past week, the prices of crypto assets have dropped sharply. Bitcoin's price has dropped by over 16%, and Ethereum's price has dropped by over 27%. Among the top 10 cryptocurrencies, Ethereum has taken the biggest hit. However, Pal is still very optimistic about crypto assets in 2024 and beyond. He says that the banana zone slipped on a banana skin and got hurt badly, but it's still early days. Cuts will make the dollar weaker, which will help build macro in the summer and fall. Right now, we are in the maximum fear zone, so hold on tight and make a plan that fits your risk tolerance and time frame. Stretch out and take it easy. This too shall pass. Don't use debt and only trade your top 3 to 5 assets as your main bag. Keep them in self-custody or multi-sig and keep your wallet clean. Only trade a small Dean bag of less than 10% HODL over a longer period of time. Views. Don't pay attention to the noise. Buy on the dip if you can. Do you think the banana zone is still in effect, or are we in a global slowdown that will cause prices to drop even more sharply? Please share your thoughts in the section below. If you like this video and want more like it, please hit the like button. Subscribe to the channel and watch our other videos for more videos with smart analysis and very optimistic statements from some of the smartest people in the business. Thank you for watching. Everything you do helps the YouTube system and makes the channel grow a lot.